There are six big Social Security changes coming in 2026 that you should have on your radar. And every January, the government makes adjustments to Social Security like an annual tune up. 2026 is no different. We're talking about six distinct changes that affect everything from how much money you get to how much you're going to pay in taxes on those tax benefits. So let me cut through the noise and show you what's really happening with your benefits in 2026. First up, let's talk about the COLA increase. COLA stands for Cost of Living Adjustment, and for 2026, we're looking at a 2.8% bump for those receiving Social Security and supplemental security income payments. And this is up from a 2.5% COLA in 2025. Now, before you start doing backflips, let me put this in perspective for you. The Social Security Administration estimates that the average retirement benefit will rise by about $56 a month from $2,015 to $2,071, starting with the payments going out in January 2026. If you're getting the average Social Security check right now, that 2.8% COLA means you're looking at an extra $672 per year. And I know you're thinking that's not exactly life-changing money. Next up, this one is for all of you who are still in the workforce. Starting in 2026, the taxable wage base is going up. And in 2025, that cap was $176,100. And for 2026, it's jumping up to $184,500. And your employer is going to be paying a little more as well. So it's a straight up tax hike for high earners. And it does not change the 6.2% you pay. It just applies that 6.2% to a bigger pile of your money. As for the self-employed individuals, you're still going to pay the full 12.4% in Social Security tax. And if you make less than $184,500, this change does not affect your paycheck one bit. But for the high earners, you could pay an additional $520.80 in Social Security tax in 2026. But after your income hits above $184,500, you don't pay into Social Security anymore. So if you're making $200,000 a year, you're going to get an extra 6.2% back in take-home pay in November or December because you've already reached the $184,500 cap, and your payroll will stop making you contribute to Social Security. Again, after $184,500. That makes sense so far, right? The third change is that the new $6,000 senior deduction that took effect in 2025 will also apply in 2026. The biggest common misconception with this new provision is that as long as you collect Social Security, you get to enjoy the $6,000 senior deduction. Wrong. It's for people over the age of 65 and not when you start collecting Social Security. So collecting Social Security at 62 does not qualify for this senior bonus and deduction. But let me clarify a few things. First, a deduction is different from a credit. A credit is fantastic. It reduces your tax bill dollar for dollar. A deduction is just good. It reduces the amount of your income that's subject to tax. So what's a $6,000 deduction actually worth? For someone in the 12% tax bracket, it's actually $720 in your pocket when you multiply $6,000 by 12%. Look, it's real money, and I'll take $720 over a sharp stick in the eye, but it's not a $6,000 check. Second, this new deduction stacks on top of your other deductions. So this is the key. You get the standard deduction, you get the existing senior bonus that people over 65 already get. And in 2026, that's $2,050 if you're single, or $1,650 per person if you're married. Now, you get this new $6,000 senior deduction on top of all of that and making it a triple stack of deductions. And if you're still confused about this, you can always schedule a 60-minute consultation with me by visiting firesignature.com/consultation, and then consider joining my private client program at firesignature.com/private clients. So let me give you a realistic scenario. Let's say you're a 67-year-old single person, and with this new $6,000 senior deduction, you now have three deductions working in your favor. First, the standard deduction for any single individual in 2026 is $16,100. Second, the existing senior bonus for being over 65 is going to be $2,050. And third, the new senior deduction from the big beautiful bill is $6,000. So put all that together and you've got $24,150 in total deductions. So let's say you are a 67-year-old and recently retired, and your adjusted gross income from your pension, your 401k withdrawals, and taxable Social Security is $60,000. You just subtract that $24,150 from your $60,000, and that means your taxable income is only $35,850. And that's what you actually pay taxes on. So that income is taxed using the progressive tax system. The first portion, $12,400, is taxed at 10%. That's $1,240. And then the next chunk, $23,450, whatever is remaining, is taxed at 12%. So that's $2,814. Add those two together, and you owe about $4,054 in federal income tax. So you're going to be paying about $338 per month. Now, compare that to the old system. That $6,000 senior deduction alone saved you $720 in annual taxes, just assuming you're in the 12% bracket. If your income was higher and pushed you into a higher marginal bracket, that deduction will end up saving you even more. And this is a big deal for managing your taxes in retirement. Now, all of this sounds great, but here comes the fine print. This is the government we're talking about. So that $6,000 deduction is not for everyone. It starts to phase out once you hit a certain income level. So if you're single, you get the full $6,000 as long as your income is below $75,000. But between $75,000 and $175,000, that deduction starts to shrink. And once you hit $175,000 in income, you don't get the $6,000 senior deduction anymore. It's gone. Just keep in mind that the difference between $75,000 and $175,000 is $100,000, and that's the phase-out range. And this is an important number to remember when you calculate your income phase-out range. Now, let me give you one more scenario. Let's say you are single, more than 65 years old, with a modified adjusted gross income of $100,000. The phase out starts at $75,000, right? So you're $25,000 into that phase out range. So what do? You take that $25,000 and you're going to divide it by $100,000, which is the size of the phase out range. And that gives you 0.25 or a 25% phase out. Now, you apply that 25% to the deduction. 25% of $6,000 is $1,500. This means your $6,000 deduction is reduced by $1,500. So your senior deduction shrinks to $4,500. You're still saving, just not the full amount. That makes sense so far, right? Now, the fourth change is the Social Security earnings test. And this one matters if you're thinking about working while collecting benefits before you hit full retirement age. And in 2026, if you're under full retirement age for the entire year, you can earn up to $24,480 before Social Security starts reducing your benefits. And that's up from $23,400 in 2025. If you earn more than that limit, Social Security will withhold $1 in benefits for every $2 you earn over the limit. So let's say you're 64, you're collecting benefits, but you're also working part-time, making, let's say, $30,000 a year. That's $5,520 over the limit. So Social Security is going to withhold $2,760 from your benefits. But here's something important. That money is not lost forever. Once you hit full retirement age, they recalculate your benefit and give you credit for those withheld months. It's not ideal, but it's not gone forever. Now, if you're hitting full retirement age in 2026, the limit is way higher. From $62,160 in 2025, you can earn up to $65,160 in the months before you reach full retirement age. And they only withhold $1 for every $3 you earn over that limit. And once you hit full retirement age, there's no limit at all. You can earn as much as you want without any reduction in benefits. So now here's the fifth change, which is all about qualifying for benefits. It's more for the younger people out there, but it's still good to understand. To qualify for Social Security, you need to earn 40 credits over your lifetime, right? In 2026, you earn 1 credit for every $1,890 in covered earnings, up to a maximum of 4 credits per year. And that's up from $80 more than the 2025 level. So if you're still building up your credits, you need to earn at least $7,560 in 2026 to max out your 4 credits for the year. Most people hit this pretty easily over their working life, but if you've got gaps in your work history or you work mostly cash jobs that did not report to Social Security, this is something to keep an eye on. Now, change number 6 is about Medicare premiums, and this one stings a bit. Medicare Part B premiums are going up to $206.50 per month in 2026, and that's an 11.6% increase from $185 in 2025. And most people have their Medicare premiums deducted straight from their Social Security checks. So what happens to that COLA raise you got is that a good chunk of it is going to get eaten up by higher Medicare premiums. You might get that extra $56 a month from COLA, but then you're paying more for Medicare. And suddenly that raise does not feel like much of a raise at all. And it's like getting a promotion at work and then finding out parking fees went up. And speaking of Medicare, if you're in an annual enrollment period right now, which runs from October 15th to December 7th, this is the time to look at your coverage and see if you need to make changes. You might want something cheaper, or your health situation has changed and you need different coverage. Your prescription drug costs might have gone up, or you're no longer happy with the quality of care in their network, or you just want to simplify everything into one plan instead of juggling multiple policies. If any of these apply to you, now's the time to shop around. And you've got until December 7th to make changes, and whatever you pick kicks in on January 1st, 2026. So here's my take on all of this. Social Security is not the most exciting topic in the world, but it's probably one of the biggest parts of your retirement income. So it's worth understanding. And these 6 changes coming in 2026 might seem small individually, but they add up. That COLA gives you a little boost. And if you're 65 or older, you could enjoy the extra $6,000 in this senior deduction. And the earnings test affects people who want to work and collect at the same time. And the credit requirements keep adjusting. And Medicare premiums keep climbing. And it's all connected and it all matters. So take the time to figure out where you stand, run the numbers. And if it's too complicated, talk to someone who can help you sort it out, because this is your money, your retirement, and you worked too hard for too long to leave money on the table just because you did not understand how the system works. And this has been another piece of a video, and I hope you got a lot out of it.